So a lot of people reach out to us for various reasons. And what we try to portray is NewHomePrograms.com. We are many things for all people. But let me tell you how this company even got started. Okay, so when you look at your flyer, the first thing we're going to talk about is who we are as a company. Now, legally, I have to tell you who we are as a company because we are a real estate company. And when you carry a real estate license in the state of Texas, you have to let the public know that we are a licensed company. I'm also a licensed real estate agent, and I'm also a realtor. So we are licensed and insured in the state of Texas to be able to help people to buy and sell properties. Now, how this company got started really was based on my personal experience when I tried to buy a home 3 different times and got turned down 3 different times. And it started when I was in the military, stationed in San Diego, probably around 19 years old. The older people in the military would say, hey, you have a good job now. What you need to do is you need to go buy a house. Anybody from California? Any Californians? Okay, well, I was stationed in San Diego. So I don't know if you've ever been to San Diego, very expensive. And this was probably around 1995, 96 timeframe. So I walked in, to a bank. No one told me, hey, go here and do this, this, this. No one showed me the steps. So I just assumed that I probably need to go get financing to see what I qualify for. And being someone that was in the military, already had a 2-year track record with my job, my credit wasn't excellent because I was a young man, right? I'd only been out of high school probably for about 2 years. So they looked at my credit, they looked at my income, and they told me I only qualified for about $89,000, right? Now, if you've ever been to San Diego, what can you buy for $89,000? You can't even buy like a piece of dirt in San Diego, right? So they told me this is what I qualified for, and I'm like, there is nothing I could buy for that amount. So I just assumed that I'm too young, and because of my age, I can't buy. Even though there were other people that had the same rank as me in the military, they actually were buying the condos and the houses back then, but it just never dawned on me. It's just because I was 19 years old, so I just assumed that it wasn't for me, right? So fast forward probably about maybe 3 or 4 years into the future, I'm now stationed in Florida. I'm a military recruiter in a county south of Tampa Bay. It's called Manatee, Sarasota County. I have an extra stripe. I'm an E6 now. And I had some people that checked into the same recruiting office where I was out of. Their rank was lower than my rank. And when they checked in and I got to know them, they were like, oh yeah, I have a house in San Diego. I have a house in Orlando. So these people had houses in other places around America. And when they checked in, they're like, yeah, we're renting for a couple months, but we're going to go and buy us a house in Florida. So I'm thinking, wait a minute, you already own a house and you're about to buy another house. And I like to live in an apartment, right? I was probably around maybe 22, 23-ish at that time. So I said, well, I've been in the military for quite a few years now, make a little bit more money. So what did I do? The same thing I did when I was in San Diego. I walked into a bank and said, I'd like to buy a house, right? They ran my credit. They looked at my job history and they said, you qualify for about $93,000. Now, in the area where I lived at, which was Sarasota and Manatee County, Sarasota is a high cost area. Like literally Oprah Winfrey has a house, Jerry Springer, and a lot of famous people have houses out there. So for $93,000, I could even probably buy a mobile in that area. So again, I'm like, well, maybe I'm just young, right? And it's just, it's not my time in life to buy a home. So I just said, you know what? I'll just keep working hard, finish my time in the military, which I did 8.5 in the military. And when I get out, I'll just get out, have my certificate of honorable discharge. I'll qualify for the VA military benefits, 0 down, and I'll just end up buying a home in whatever state that I land in. So Texas happened to be the state where I ended up getting a job from the military. And I did the same thing, worked for about a year. And I said, okay, I have a good job. There's lots of houses that are being built all over the city of Houston, right? So I said, you know what? Maybe now's the time to go ahead and get that house. By this time, I was probably like 25, 26 years old. This was 2001 is when I got out. I rented for a year. So we're talking about 2002. I was ready to go ahead and apply for a mortgage. Now, how many people know where West Oaks Mall is? right? So remember going south on Highway 6, before you hit Westheimer, on the right-hand side was Countrywide Home Loans. Anybody remember that? It used to be in that little strip center. They were one of the largest mortgage lenders in America. So I figured I just walk in. Hey, I just got out the military, still was a Navy reservist, right? So I'm thinking they're still gonna give me some type of favor because I'm still in. And I sat down with the lady named Rhonda Thomas, punched my information in the computer, ran my credit, looked at my income, and she said, well, you qualify for a $98,000 house. Now, this was 2002 in Texas. I could have technically got a house for about 98,000, but it was going to be an older house and it was going to be nowhere near where I was renting. I remember I was paying $1,000 a month for a 2-bedroom, 900 square foot apartment. And the reason I chose that apartment because they had an indoor basketball court, right? So 2 bedrooms, $900. And I just figured if I can pay $900 was a lot of money back in 2002. So if you're saying, oh, that was cheap, it wasn't cheap back then. That was kind of like a high end to pay like $1,000. So I said, if I have a good job and I can pay $1,000 for an apartment, surely I can pay $1,000 or a little bit more for a house. The problem was they didn't qualify me for a lot of money, right? And there's no way you find a house for $98,000 anywhere near Westheimer in that Richmond area. So this time around, while I was standing in Rhonda Thomas' office at Countrywide, I did something different this time that I didn't do the first 2 times. Who can tell me what did I do different this time? Well, I was in a mortgage place, the biggest mortgage place in America.
You didn't accept the answer, you asked questions.
That's right. So she said it in a nice way. This is how I said it. Listen, lady, you're gonna tell me exactly why I do not qualify to buy a home because I just spent 8.5 years serving my country and I'm still in the military. And I went in the military to get benefits and now you telling me I wasted my time? And I'm like, you're gonna tell me exactly why I can't buy a house, okay? Rhonda Thomas, still to this day, she's my friend, right? So she said, not a problem. Let me show you something. So what she did was she pulled up my credit report and she said, this $550 monthly debt is an automobile. Is that your car payment? I said, well, of course it is. It's my Mustang Cobra that's out in the parking lot, right? $550 back in 2002. That was a lot of money back then. But let me tell you something. When you are in the military and they pay for your room and board, they pay for your food, they pay for your clothes, they pay for your health care, right? What else are you gonna spend your money on? Right? Somebody in here knows people that went in the military and came back from boot camp with a fancy car, right? You're like, how do you get that? Because you don't have anything else to spend your money on, right? And kids ain't gonna save money. Now, I was a kid when I went in. So in the military, that was normal for a young person to have a $400-500 car payment, sports car, and probably a motorcycle too, right? Because there's nothing else to spend your money on. In my situation, I had 2 cars. So the Ford Explorer, because I'm from West Virginia, right? So you got to have some type of off-roading vehicle, right? So I had a $550 car payment for the Mustang and a $550 car payment for the Ford Explorer. That's $1,100 a month in debt, tied into cars, right? So, and this is what she explained to me. She said, for every $100 a month that you have in debt, obligated to pay every month on your credit report, you go down or you drop $10,000 on the amount you qualify for. That's back when rates were like 6.75, right? So I said, wait a minute, lady, you telling me, because I got $1,100 worth of debt. If I didn't have that $1,100 worth of debt, and I already qualified for about 98, I would qualify for 110,000 more? She said, yeah. I said, well, why didn't somebody tell me this? Because I tell you, by the time I got to Texas, I had already purchased 4 or 5 cars. I was flipping cars every couple of years. Every time I made rate, I would trade them in. So I always carried high car payments. Never did anyone say, if you ever want to buy a house, make sure you keep your debt low, because that's how they're going to determine how much you qualify for. So now that she gave me that little nugget, I said, you know what? Hold on, Miss Rhonda. I walked outside of Countrywide Home Loans, stood right there on the curb, got my little phone, StarTech. Remember StarTech came out? StarTech. I called Navy Federal Credit Union and I said, listen, I'm trying to buy a house and I've been very loyal to you guys. I bought so many cars to you guys. What I need you to do for me, please, is I need you to refinance those cars because I always got a 5-year term. I'd already paid at least 3 years on each one of them. So I only had 2 years left on each one. So I said, whatever the balances are, can you restart the loan over, stretch the loan out as far as you can, the terms, to lower my monthly payments? They literally did that over the phone. Each $550 car payment dropped to $250. So now I only have $500 of monthly debt. So then I said, can you go ahead and fax that information over to Miss Rhonda? Okay. I walk right back in. I said, you're going to get a fax from Navy Federal. And what it's going to show you is the new loan amounts and my new monthly payments. As soon as it came in, she looked at me and was like, wow, you just did that outside on the curb? Yes. That's how bad I wanted to buy a house. And I'm going to tell you why I really wanted to buy a house bad. So she went ahead, punched in the new numbers. Miraculously, I qualified for like $150,000 just like that by picking up the phone. Got that pre-approval. I worked at a company when I got out of the Navy where the secretary was a licensed real estate agent. So when I was telling her, hey, I want to buy a house, she'd be like, oh, when you get approved for something, let me know, and then I'll show you houses, right? She never helped me do anything, right? So, but still, I got the little approval letter, called her up. Literally within 7 days, we found a house out in Katy. You guys know where the JCPenney's is out in Katy?
Yeah.
Okay, back then, there was no JCPenney's, right? There was no movie theater. I think Katy Mills Mall was probably there back then. But there was a neighborhood called Williamsburg Parish. It was only probably like 5 or 6 years old. Somebody put his house up for sale. It was another military guy, Army guy, put a contract on it. Let me tell you the type of house I got. Remember, I was in a 900 square foot apartment, paying $1,000. This house was 2,400 square feet, 4 bedrooms. It actually had 2 living rooms. That's the first time I ever heard of like a family room and a formal living room, right? I always heard of like a living room. This thing had 2 family rooms in it, right? I had a 2-car garage because you know when you're in an apartment, you got to pay like $100 just for a 1-car garage, right? So I had a 2-car garage, humongous backyard, right? My payment was $1,089. So I only went up by $89, but the square footage doubled from what I was paying, and I got the 2-car garage. And I moved in within 30 days. Moved in 30 days from the time I picked up the phone after making a decision that, hey, y'all gonna stop telling me that I can't buy a house because I know something's fishy, something's wrong, I'm missing something, right? And as soon as I figured it out, boom, in 30 days, I moved into that house. Now, let me tell you why I was so adamant about buying a house this time, right? And I was relentless. I wasn't gonna let nobody tell me no. Remember when I told you I had the opportunity to buy a house in California? The reason that they only qualified me for the $89,000 is the first thing that I did when I graduated boot camp, I went and bought a Nissan, right? It was a used car. Then within a year, I got promoted to E5 and I traded for a brand new Mustang 5.0. That thing cost like 24 grand. And at that time, I think I would just turn 19 years old and that had a hefty payment on it, right? So the thing is, if I wouldn't have carried all that debt and I would have bought a house in San Diego, even if it was a 1-bedroom condo, do you guys remember what happened all the way up to 2006 in California with the housing bubble? A person who would buy like a $125,000 condo, they were selling it for over $400,000. Yeah, y'all remember that? Y'all remember that? So think about it. If I would have been the one who would have bought that 1-bedroom condo, because I had to transfer to San Diego, so I could have kept the property and had it as an investment, or I could have sold it, I could have easily went to Florida with $300,000 in my pocket from the sale of that house. Now, y'all remember what happened in Florida with the real estate? It does the same thing in California. The prices of the houses started doubling. So a person who bought a $200,000 house in Florida, that house would have sold for $400,000, $500,000. I know people in the Navy that when they checked in the first year and bought a house, by the time they got out the military 3 or 4 years ago, they already put like 200,000 in their pocket because the house is doubled in price. So if I would have bought in Florida, because I would have had cash, I would have had 300,000, I wouldn't need a loan if I had the cash, right? I could have bought a house for 200,000 in cash, still had 100,000 in my pocket. And then the 3 years after I left, if it would have doubled in price, that house would have been probably 400,000. So I could have sold that house and came to Houston and bought a house at a minimum 300,000 to 400,000 in cash back in 2002, when the houses weren't as pricey as it is right now. See? And when I came to Houston, I was only like 25, 26 years old. So I regret being ignorant, because that's what I was. I was ignorant, right? Because imagine how my life would have been different in my 30s if I was sitting on $500,000 worth of real estate in 2001. See? So I know a wise king once said that my people perish for lack of knowledge. And let me tell you, I work hard now because I didn't have the intelligence back then, right? Because I'm gonna be 46 in a couple months, right? So how did NewHomePrograms.com get started? It started because of my personal experience, right? The issues that I had in buying a home, and they were minor issues. I didn't have horrible credit. I didn't have excellent credit, but I didn't have horrible credit. The only thing I was missing is I didn't understand the home buying process, and it cost me big time. It made me have to work harder in life to be able to do it, okay? So when I had that job, as I told you guys, from the military, economy kind of got bad. Everybody was laying off around that 2001, 2002, 2003. So I ended up getting an opportunity to work with one of Houston's largest family-owned home builders in the city called Royce Homes. Anybody remember Royce Builders or Royce Homes? Had the big old building off of Beltway 8. It said RoyceBuilders.com across the street from the racetrack. Well, I worked for that company. And when I worked for that company, I was in a position where when people came to the website and they submitted their information, I would call them and set up an appointment and talk to them about buying Royce homes. What I found out from dealing with hundreds of people that were coming in, they were just as clueless as me. So I said, you know what? I'm not really in the house selling business. I'm in the education business of how to purchase a house. So after working for Royce after about a year, I just had a lot of people that were being educated to the point that I couldn't stay at that particular home builder because the people that I was, helping and educating, they were all over the city. And at that time, there were so many other houses for sale, and they needed my help to show them how to buy outside the Royce homes, okay? This guy in the back right there, Noel, he actually worked at that company with me 17 years ago. So he knows me before NewHomePrograms.com, so he can vouch for my testimony. So, but when I worked at Royce, and I started to see the amount of people that really wanted to buy homes, but they didn't have the knowledge or the education, I just dedicated myself to say, you know what? My goal is to make sure that every person that I talk to owns a home. So, who is NewHomePrograms.com? Right here on the front part. We are a licensed real estate company. We also have our own mortgage company, which we bought in 2017. It's actually a franchise called Model Mortgage. It's a national mortgage company, now probably in about 39 states. Our, name to fame of why people really know us or heard of us or why they're interested in coming to see us is because of our programs, okay? Now, I named it NewHomePrograms.com almost 2 decades ago because I knew the internet was gonna blow up, and when people were looking for homes, they were gonna go to the internet, right? Because why? When I tried to buy a home, there was nothing on the internet. So I said, well, let me be the first person to put information about the home buying process and how to fix your credit and down payment programs. Let me put that on the internet, and that's what I did back in 2004, okay? So yes, we are a .com, but we're a real company with real human beings that you can actually come in and meet with us. And here's some of the programs that we offer. Okay, I'm not going to go through all the programs because you can actually go to our website and do your research on some of them. But regardless, if you're a client of ours, we're going to match you up to as many programs as we can. And these are programs that we design. So I'll just give you an example of 2. What do you think is the #1 stumbling block that's going to stop a person from buying a house?
Credit.
Credit, right? We can all agree to that. And let me tell you, we've pulled thousands of people's credit reports over the 17 years, right? And when someone has issues with credit, it's not that they're bad people, right? Because sometimes things happen to us in life it's out of our control, right? Like if you get laid off and you can't pay your bills, that don't make you a bad person because you can't pay your bills, right? You got laid off, you can't control it. Or if somebody goes through a divorce, right? And the judge like, who pays what, right? So everybody says, well, I'm not gonna pay something until my lawyer tells me what's gonna be my debt. So a lot of times when people have issues with credit, it's not that they're bad people, it's just they don't understand how credit works and how what you do today with credit is gonna affect you 5 years in the future and even 7 years. Because why? Negative stuff can stay on your credit for 7 to 10 years based on what it is, okay? So our number one program that we're really known for, it is our credit enhancement program. It is not credit repair, okay? But it's similar in nature. Credit repair is, hey, your score is a 505 and we're just gonna, take a lot of bad stuff off your credit and go get a couple secure credit cards. And then, whatever your score is gonna be, as long as it's higher than 505, then you did good, right? No, our credit enhancement, and the reason we call it enhancement is where you're at today. We're going to enhance your financial situation. So when you do get ready to make loan application, you will be in the best possible situation to get a mortgage loan. So what I'm saying is there is an objective of what we're doing with the credit, and that's to make sure you can get the best loan. Because in this day and age, if you got bad credit, you typically take the leftovers type stuff, like the high interest rate, bad credit cards and things like that, right? So we're not trying to put people even lower than what they're coming in, right? We're trying to get you out of that position and get you the best type. So what we're trying to do is make it where banks will literally fight for your business, right? So it has a little bit more to do than just getting your credit score to go up. There's other things that banks also look for as well. And that's one of our topics is mortgage financing. Okay, now our credit enhancement program, we do not charge for it, right? Credit repair companies, they typically will charge you a monthly fee. And the thing is, you'll keep paying the fee until you decide, hey, my credit is where I want it to be, and then you drop out. So there is no real end game. Our end game is, as soon as we get your credit to the point you can get an awesome loan, then we don't need to work with the credit because we've already fulfilled the objective, okay? It's free. We've been running a promotion now probably for like 3 years that if you have to go in that program and you do exactly what we tell you to do and you graduate and you close on your home, which means you get your keys, we actually give you a graduation bonus of $500. We pay you to go through our program. And that $500 can be used towards the purchase of your house and to also offset any costs you may have incurred, like getting a secured credit card, which, that costs money. You got to put a deposit for that type of stuff. Okay, so that's an example of one of our programs that we have to offer. The other ones would be like no money down loans or different type of programs that can help you with your down payment. Okay, so what is the down payment requirement? Just a consensus. What do you guys think the down payment requirement is to buy a home?
10%.
You said 10%? What do you say?
2%.
Depends. Okay, good question. Good question.
5%.
5%?
I say it just depends if it's FHA or whatever. If I say it could be 2%, 10%.
Okay, you did your research.
Mhm.
3%?
3 to 10.
3 to 20? 10? 5? 10? Okay. So you see how we're all over the board here? See, that's the other thing. If you don't know exactly what you need to save, then you probably ain't gonna save, right? So there's different types of loans out there. And yes, it's based on your income, it's based on your credit score. But the thing is there's loans that are as low as 0 down, right? Like if you want to live in a rural area, USDA, which is an area where there's less than 10,000 people in a population. Like I live in Wood Forest in Montgomery, right? And in Wood Forest, on one side, not my side, they got a side, they got like $800 to $1 million houses, right? On the opposite side of Fish Creek, right? Believe it or not, even though there's like high-priced homes, that neighborhood qualifies for no money down because the area of Wood Forest, there's less than 10,000 people that live in that area. See? If you go out to Fulshire, Brookshire, if you go out to Porter, Texas, qualifies for no money down. On the south side, you go to like Texas City, you go to like areas of like Rochelle, even on the south side of Lake Conroe, there's some areas that are incorporated areas and they have less than 10,000 people. Okay, so yes, there's programs that are no money down, and then there's programs that are 3% down, conventional type loans. We do have it for first time home buyers or folks that have 80% or less income based on the average in the area. But the main point is you got to know what you qualify for so you can at least know what your down payment requirement is. Because if you don't know that number, you're not going to save. And if I just tell everybody, oh, you got to save 10% down, prices are going up like crazy, right? So probably just a decent house now is going to be $200,000. If I tell you, you need to save $20,000 and you're like, well, my income is 45, right? Then you're looking at the math thinking, I ain't gonna have a house probably until like the next 4 or 5 years, because you have to save literally half of your income, per year. So that's an example of programs that we have no money down. And also there are grant programs that can also help you as well, okay? As I mentioned, we've been operating since 2004. We are licensed in the entire state of Texas. We do have operations here in Houston. We cover 9 counties, but we just added the Bryan, Texas and College Station. That added another 6 counties. We also have people on the ground in San Antonio, Austin, and Dallas. And then we're also licensed in Florida in case anybody wants to move to Florida. We got you covered over there, okay? Tampa, down to Orlando, all the way down to Sarasota. We can assist you there as well. The first step is understanding credit. Let me tell you why. You walk in to the bank, right? And you're going to deal with what they call a mortgage loan originator. We got them here, right? Their office is right next behind me, right? So when they pre-approve you, that pre-approval is good for 60 days based on your credit. That snapshot, right? After 60 days, they're going to rerun your credit. Now, a mortgage loan originator, they make money when you move into your house. So they're not thinking, hey, I see that there's things on your credit that maybe if you just took a couple months to work on, you'd probably get a better loan, right? They're not thinking that way. They're thinking, hey, you need to go find a house very quickly, buy it so that you can close real quick and then they can get the commission, right? So that's why you have to know what your credit is up front and what that's going to mean before you go and try to apply for a mortgage. Because as soon as you step in their office, oh yeah, you're qualified for 180. Well, if they told you that today, guess what? It's very difficult finding homes for 180 in this local vicinity, right? You can go out to the country and probably get something, but around here, that's going to be tough, right? So you might be that type of person like me that had to restructure your debt so that you can qualify for probably 210 and then go get your brand new house with like D.R. Horton or something, right? So credit is the #1 thing. And honestly, it's probably the more difficult because a lot of times you have to face reality, right? You got to say, yeah, I know why my score is this because of this, and this, but that's fine. The past is the past, right? But as long as you know the formula of moving forward to get your credit to where it needs to be favorable in the eyes of lenders, then it becomes more exciting, okay? So a couple things real quick. What is the credit score that you need to have to get a good loan? Before we answer, what is a good loan? So my definition of good loan is a loan that gives you the lowest possible interest rate based on your financial status, right? But also the loan is asking you for the least amount of money for a down payment. Why? There's everybody out there will say, if you got the money, put the money down into your house. And yeah, you can, but if you put $10,000 down in your house when rates are like in the high 2s and low 3s, you may save probably $30 a month in your payment. So do you want to give somebody $10,000 to save 30, or take that $10,000 and invest it in something that you can get a return way greater than 3%? Or like maybe start your business, send your kids to school, pay your car off, right? And get rid of the $550 car note. So my thing is, I'm not trying to tie up cash into a property that if I need to get that money back, there's a way I could get it back, but it ain't gonna be easy to get that money back out of your house. I'd rather have it somewhere in case something happened, I can use that so that I don't have issues, right? So to me, it's based on your current financial situation, getting set up with a loan that's gonna require the least amount of money out of your pocket and the lowest interest rate. Another thing about that is, if you guys remember when the market crashed in 2007 out here in Houston, right? There was people that put a lot of money down on their house. And then when 2006 and 2007 came, what happened to the values of the house? It went down. It went down so low for a lot of people that money that they put down, if they got into a bind and had to sell the house, they would not get their money back. Yeah. I know a lot of people that did that, put the 20% down on their home, and then their house values dropped by 30 to 40% when the housing crash happened. And they couldn't sell the house to get their money back. That's what they call a short sale, right? They were upside down on it. So they lost that money that they put as a down payment. Okay, so back to the credit score. Someone said 620. Anybody else? What will be that credit score number that you need? 650?
You need
At
a
least
good,
580.
580?
that's why I was missing a good credit score, so she could get in, I think, with a 580.
Good loan. I'm talking about a good loan now.
Good
Oh,
loan.
Good loan.
Okay,
Oh,
well,
See, that's where they trick you. Oh, you can get a loan at a
Okay.
580, but they're not telling you it's not a good loan.
a good loan is 700.
Say 7.
I said 680.
680. Okay. So here's the thing. Everybody will give you a different answer. That's why I always tied into a good loan, least amount of money down and lowest interest rate. What types of loans are giving people lower interest rates? Government insured loans, FHA, VA, USDA, right? And there are some conventional loans that are designed for people that don't have a lot of income. So to get the government insured loans, what we typically see by pulling credit, and we have the computer system that will give you the automatic approval. At a 640, that's the number when typically you're not gonna have a problem getting an FHA loan, okay? Could you get an FHA loan at a 580? Most definitely, but you may have to have a human being to look at the loan and do what's called a manual underwrite, which means the computer didn't approve you, right? So a human's gonna approve you, and because they're like, you're risky, because the computer says you're risky, we now gotta give you a 1% higher interest rate, even on a government loan. Now, the difference in a rate between someone that has a 640 and a 639, that difference can be a 1%. Yeah, off of 1 point. See? So the thing is, when it comes to credit scores, if you're not at a 640, we're gonna be honest with you and say, listen, we're connected to 9 multi-billion-dollar banks and we got their pricing engine. So it's not like we make this stuff up. We can show you. If you're at a 639, here's the rate today with 5 different limits, right? And then you can make the choice. But if you're not in a hurry and there's a couple things you can do with your credit to get that boost, then we'd rather wait for you to be able to get that, okay? So let's talk about credit, because now you're thinking, how can I get that 640 or get it higher? And yes, technically, if you do have a 700 credit score, you can get a lower rate, but on an FHA, the guideline is you got to put 3.5% down. So if you're at a 641, you got to put 3.5% down. And if you're at a 751, guess how much you got to put down? 3.5%. The only other benefit is probably you're going to get a little bit better on the interest rate. Okay. Maybe you can get a 0.25%. Yeah, you save like $6-7 a month a day.
617.
That's
Yeah.
all.
Yeah.
Wow.
Yeah. And again, we have the pricing engines for 9 different multi-billion-dollar national banks. So when we plug in the data, it's what we call a rate quote, right? We can actually show you. And by Texas law, because we have a real estate brokerage, we have to show you 3 different quotes, right? So then you know that you're getting the best deal. That's because we're a mortgage broker, which means we're not like a bank. We're not like Bank of America. Bank of America, they give you their product. So it's like, hey, you want this? You're going to take whatever they give you. We're a broker. We're connected to banks. We pull the credit. We gather up all your documentation. And then we send your file to the banks and see which one of those can get you qualified for. Kind of like Progressive Insurance. Okay. So then you know you're getting the best rate. So let's talk about credit real quick. Because now that you understand that based on your credit, will determine if you get what? A good loan, right? So how many people use Credit Karma? Credit Karma? Okay. So a lot of people know Credit Karma because it's free, right? And honestly, it is a little bit easier than a lot of other credit programs because they got that mobile app, right? Even though it only shows you 2 of the credit scores, which by the way, are not accurate at all when it comes time to get a house, because they use a Vantage 3.0 model. Mortgage companies, we use a FICO model. But what I do like about Credit Karma is they can let you see how you're doing based on the 5 factors. Okay, so let's talk about the 5 factors. Factor number 1, and this is how you read this thing. Now, there's 3 credit bureaus. They each have their own range when it comes to credit score. I'm using an example of TransUnion. It's 309 to 839. If you look at the top, 309 is the lowest, 839 is the highest. Also, not only do you have 3 credit bureaus, they each have a different software based on the industry of what you're trying to get approved for credit. Credit cards have their own version of FICO, just like mortgage companies have their own version of FICO. That's why when you have, let's say, a Capital One card, and you're looking at your Experian through CreditWise, and you're like, why does it say this? But then I have my credit pulled by a mortgage company, and the mortgage company could be higher or lower. It's because CreditWise is based off of a credit score model. Think about it, you're getting your credit score through a credit card, Capital One. And their thing is they want to give you higher lines of increase, so they choose to use a FICO model tied into the credit card algorithm. Okay, so this range is not going to be 100% perfect, but what is perfect is the makeup of the 5 factors, the percentages. Okay, so if we use a scale of 309 to 839, that gives you a possible maximum points of 530 points, right? So if you start at 309 and then you got all 530 points, you'd be at an 839 FICO or credit score, okay? So knowing that, you should be thinking, how can I get my hands on all 530 points? Okay, so that's the goal, that's the mentality. If I can get up to 530 points that I can accumulate, then how can I do that? So step 1, how you pay your bills. How you pay your bills is 35% of what? 35% of what? What's the most points that you can get based on this example?
185.5.
Okay, 530 points is the range, right? This is saying 35% of 530, it is 185 points. So how you pay your bills is worth 185 points, okay? This one is so simple to dominate because you either pay your bills or you don't pay your bills, right? So you pay your bill on time or you don't make the payment on time and it becomes 30 days late and you just took a hit, probably like 40 points. Then you'd say, I'm not gonna pay it again for another month. Then you're 60 days late. You probably drop like another 20 to 30 points, right? By that time, you could probably be pushing the low 500s, right? And then you keep going late, and eventually, after about 5 months late, what happens to it? It goes in collection, right? So when you do have something on your credit, you got to make the decision, I'm gonna pay it. Or you make the decision, I ain't gonna pay it. But the more stuff you have that you make the decision, I am gonna pay it, then guess what? You could be chipping away at that 185 points. If you go late on something, let's say that your bill is due on the 30th every month, right? You get the bill on the 1st and it's late on the 30th because this scoring system, it goes by 30 days late, right? The bill comes on the 1st, and let's just say you got to pay it by the 30th, right? You don't pay it on the 30th. You pay it on the 35th, right? By the time not the 35th, 5 days into the next month, right? What month got 35 days? So let's say the next month on the 5th, you pay it. What just happened on the 1st of the next month? You got the next bill, right? And on the next bill, it says, not only do you owe that payment for last month and a late fee of $35, but you also owe the current month. So in that second month, if you pay the previous month, you still on hook for that month, plus the $35. So, and if you don't pay it that month, because you're like, well, I just made a payment this month. Well, no, you made a last month's payment this month. Then what's gonna happen is on your credit report, it's gonna show you late by 30 days every single month until you make 2 payments to catch the past balance up. Okay? So here's the thing. It don't matter how much your payment is. What matters is, did you go 1 full month without paying? What I always recommend, especially if you've never been late before, always call the creditor, right? And if you can't pay it, there must be an excuse. Nobody just says, I got a lot of money and I just don't want to pay my bills, right? Whatever that reason is that you can't pay it, call them. Be very nice on the phone to them. God bless you and may you prosper, make his face shine upon you and give you a peace, right? And then say, can you help me out, please? I've been a loyal customer, right? That's the first thing I always say when I call bills, right? I've been such a loyal customer. Is there any loyal customer more loyal than me, right? And then just plead with them and see what they can do, right? You'd be surprised what these people will be able to do, okay? So remember, it don't matter how much the bill is. It could be a $5 payment. And you're like, oh, it's only $5. I'll just double up next. Don't do that, because if you go late, then that mark is going to hit you. And guess how long the mark can stay on your credit? A late payment can stay on for 7 years. And you don't start regaining the points you lost until it's already past 12 months. Yeah. That's why in the FHA guidelines, even if you do have group credit, they don't want you to have more than 2 30-day lates in the last 12 months, or they'll accept 1 60-day late payment if your score is still high. Okay, so they don't just look at your score, they look at your payment history in the last 12 months on your credit report. Okay, so using this math, if you started at 309, and let's say you accumulated the whole 185.5 points, you're now at 494.5. Okay, big jump from 309. Now, number 2, revolving balances. Who can tell me what a revolving balance is? Credit card, not a car note. Revolving. Credit cards, okay. Then most people know revolving is credit card. Let me give you an example. You know how when you go to these big cities, they got these fancy hotels and they got the revolving door, right? They got the guy who stands there because the door don't ever lock, because people come in all times of night. You can go in and you can go out, right? But it never closes. So revolving is an account you can charge up and you can pay it down and it don't close. An installment loan, being like a car, is what they call a term loan. You got 72 payments at $500 a month, and the last payment that you make is closed. Okay, so the first thing you got to understand about revolving is it is the best type of credit that you can have on your credit report. So if you say, oh, I had credit cards before and I'll never get one again. No, you want to have a credit card. You don't have to charge it up every month, but you do want to have it. Why? Because the longer you keep it open, then you have a longer account history, which actually is item number 3. So with the revolving credit, you're kind of taking care of 2 things at one time. You get it, keep it over. Every year that you have it open, you're getting more credit points. But here's the thing. The way that you can get that 30%, because it's 30% of what? 530 points, which is 159 points up for grabs. That's a lot of points, okay? When you get that revolving credit, this is how it calculates in your score. When you charge a credit card up or any type of revolving credit up, guess what happens to your credit score? It goes down. Yeah. Think of it this way. You charge a card up, credit score goes down. If you ever looked at Credit Karma, go ahead and charge some credit cards up and let it update and watch you drop. Now remember, it's 159 points. So people are like, oh my God, I had a 750, but now I'm like a 602. How did that happen? I've never paid my bills late. It's because you max your credit cards up.
Say keep it less than 30%.
Okay, where'd you hear that from?
I was always told that you want to keep it.
You was always told by who?
Different people. Oh, yeah, credit.
Name one person. Jim, John, the man. People in the bank. Ah, people in the bank.
Say if you have $1,000 credit card,
People in
say
the bank.
500, you don't want it to go above like
Okay.
one
So who
twenty-five.
told you that? People in the banks.
Yeah.
Okay, think about it. How do banks make their money?
When they.
If you got a balance, they make interest. right? Think about it. If I was a bank, I'd say to keep a 30% balance. Why? Because I'm guaranteed to make
I mean,
interest off of you.
less than 30%, you don't want to go max it out.
So here's the thing. Let me tell you how banks make them. And I'm telling you, because we used to have our own credit card, like our company had a partnership with Visa and First National Bank of Omaha, right? So there's like 4 or 5 different ways banks make money off of that plastic, right? So number one, every time you swipe it is a transaction fee that can be up to 3%. So when they tell you, you always got to keep a balance, then what are you always going to be doing? Swiping that card, right? So even if you swipe the card and charge $100 and paid it off the next day, which means they didn't make any interest, they still made up to 3% on the $100, right? So there's a whole army of people in this country that swear by that. I'm going to keep a 10% balance. I'm going to keep a 20. Oh, I just paid the payment. I got to go and charge it again. They making you afraid to the point that they making money off your fear, right? The merchant transaction fees. That's one way they make it. They make it off the annual fee. If there's an annual fee on it, they make it off the over the limit fees as well, right? So there's like so many ways that they make money. But I asked that question, who told you about that 30%? Nobody can name like a human being that's like a friend of theirs, right? But it always comes back. I watched on like TV or I looked on the website and it's recommending keeping that balance below the 30%, right? So, but here's what I'm telling you, that when you have a balance, then your credit is going to drop. It's interconnected. You cannot get around it. Now, I can tell you with the 159 points, and I've tried this, if you max all your credit cards up, right, you're not going to drop the whole 159 points. So why is it that it says you can gain or lose 159? If I personally tried it and maxed my cards up and I didn't lose 159, how can a person drop 159 points? You go over the limit. How many people know that if you have a $1,000 limit, you could probably charge $1,300 on that card? A lot of banks let you go over the limit. So now they got an over limit fee that they just hit you with, probably like 35 bucks, right? Plus they're charging you interest on the 1,300 where you thinking that they're only going to charge you on 1,000, but no, you went over it. So when you go over your limit, that's how you can drop up to 159 points. Now, I'm giving you like $1,000 credit card limit, but most people that are rebuilding their credit, they only have a $200 to $300 secure credit card. How much does it cost for a tank of gas these days? I know mine is 50 bucks every time I fill up. And I got to fill up at least 3 times a week. So if I had a $200 credit card, right, and it allowed me to go over the limit, most definitely I would end up going over the limit. And if you hustle and working every day, you're not thinking about checking your balance every day to make sure you don't go over your limit. So you can literally lose up to 159 points by going over your limit, okay?
So let's go back to that whatever it is in the swipe.
Merchant transaction fee.
Okay, so are you saying we just got a card and don't use it so that nobody can charge on it? You can't
Okay.
charge on it, they
Good
are.
question. Good question.
Yeah.
So you're going with this.
Zero balance.
So here's what you got to do. Everybody knows that it normally takes at least 30 days for your credit history to cycle around every month, right? On Credit Karma, this is another reason I like it. It'll tell you the last time your credit card info or any credit that you have was updated with the Bureau. So if I look at it and it says, what month are we in? We in June? So let's say June 11th, my Capital One updated to the Credit Bureau. Then what I'm going to do next month is I'm probably going to subtract about 5 days, right? Because that number, it does shift based on weekends and things like that, right? I would probably say 5 days before the 11th, because my Capital One is through Walmart. So I get the points. I just put everything on that card with Walmart, right? But 5 days prior, I have a notification. I will pay it down to 0, right? Because why? You never know when you're going to have to go out and get a house. And when you go to get a house and they pull your credit and they get that snapshot, if you got $50 credit card payment there, $110 credit card payment there, they start adding up all those debts. And remember I told you about the $100 rule? For every $100 you go down by 10,000. It ain't 10,000 now, but it's probably somewhere like 5,000 to 6,000 because rates are low, right? But the thing is, you always want your credit to be zero or pretty close to zero, right? Like you can have a balance of $10 and your payment's like $2, right? $2 ain't gonna hurt you. So that's what I recommend is before the update period, go ahead and get that thing as low as you can. I keep mine at zero. I know there's some companies that give you credit cards that if you have a zero, somehow your score turns out to be a couple points lower than if you carry like a $5 balance on it. We have a software that tells us if you pay this particular card down and leave $5 on it, this is what your credit score is going to do. Yeah, because banks always want you to carry a balance. So there's a way that some banks can hurt your credit if you carry that zero balance. Not all banks, but there's certain banks. Somehow they do it. I don't know how they do it. That's above my pay grade. Okay. So if you're going to buy a home, we always recommend 60 days prior to you needing to get financed, pay them all down to zero. Okay. Because if you pay it down to zero, then we don't have to count that monthly debt against how much you can qualify for. Okay. All right, so let me give you a couple of tricks about how you can boost your credit with these credit cards. Now remember this, when you charge your credit card up, your score goes down, right? So let's take a look at a $1,000 limit. If you have a $1,000 limit and you owe $500, you 50% maxed out. Or the way you can look at it is you only have availability of 50% on that trade line, right? It's that availability is what's determining your credit score, right? Because if you charge all your cards up, you become a more risky person. You're closer to being someone who can't pay your bills because you carry high balances. So let's say that you're at 50%, which means you lost 50 points. Remember, I can show you where you can lose 100 points by maxing it to the limit, not going over, but maxing it, right? So if you're 50% maxed out, let's just divide that 100 points by 50. So let's say you're maxed out 50% and you lost 50 points and you need to get just 10 points to get to the 640 to get a good loan, right? If you had no money to put down to pay that 50% down, that 500 on that 1,000 line down, what could you do to get your credit scores to go up? If you had no money to pay that balance down, you don't line to your Capital One, hit the credit line increase, and it'll ask you, what do you want, right? You just choose it, you know? I want $2,000 limit, right? They might come back and say, nah, we'll give you a $1,500, right? But regardless, getting anything above what you already have, it drops your balance percentage down. So that's one trick. Just keep hitting the credit line increase, right? Don't do it if you don't have 640 credit scores or plus, right? Because they're probably not going to give it to you, right? But do that, increase your credit line. So now you got a $2,000 limit and you only owe $500. You're only 25% maxed out. So that 50 points that you lost, you could have probably got that 25 points back. That's one way. Another way is open another credit card. Because what they do is they look at all the balances across all revolving accounts and they compare it to all the limits. So if you had a $1,000 credit card and you owe $500, you're 50% maxed out. And then you open another credit card and they give you a $1,000 credit line, but you owe nothing. You add the limits, 2,000, the balance is 500. It's the same thing. You're 25% maxed out now.
You're talking about opening up another credit card with another company.
Yeah.
Okay.
But it's when you are in that moment to buy the house, but what about the inquires? That is not
In
good.
acquire, we only hurt you probably 2 to 3 points. We're talking about what if you can get 25 points? Yeah. So this is something we're probably not going to tell you like right before you're trying to get a house. See, in our credit enhancement program, sometimes people are in it for 90 days, 6 months. So there's little things that you can do within that window of time to get you more prepared for buying a home. And a lot of times when people do reach out to us for our services, they still have some time on their apartment lease, or, you know, most of the time they're probably reaching out 3 to 6 months before they're ready to do something. That's a lot of time that we can work with credit. okay? But if you just like, hey, my apartment lease is up at the end of this month, I need to move in, yeah, that's gonna be kind of tough. Okay, so any questions about revolving credit? Credit history is based on what you have currently open. A lot of people say, oh, I own like 5 cars that I paid off in the last decade, so I should have a lot of credit history, right? Well, yeah, you have a lot of credit history, but those cars you paid off aren't doing anything for your credit score, right? So if you got your Credit Karma, who's got Credit Karma? Okay. Let me show you something real quick because this might be something that you may not look at. So when you open your Credit Karma and you click on one of the scores, you're going to go to, it is number 1, 2, 3, 4th down. You see where mine, the first red? See that first red? Red means bad, right? Green means good. So I've got a bunch of green and I've got a red. And it says age of credit history, 3 years and 8 months, right? Now I told you I had a bunch of cars, like, you know, when I was in the military, right? Like a bunch of stuff. The problem is once you pay it off, it doesn't calculate in your credit history. So when someone says, hey, I've been paying on this car for 4.5 years and I'm going to buy a house, I think I'm going to pay my car off first and then I'm going to apply for the house. Well, guess what? You pay your car off, you just lost 5 years credit history. And if you look at Credit Karma and you click on it, for example, I click on my red, it's going to show me this right here, right? It's going to say I got 3 years and 8 months, right? And there's like a little color code. So it says, if you have less than 2 years, you're red. If it's 2 to 4 years, you're orange. If you're 5 to 6 years, you're yellow. And then 7 to 8 years is green. And then it has another one, 9+ years is green. So in order to maximize that 79 points, typically your open credit has to be probably 7 years or longer. That's why, remember when I told you that having a credit card is probably the best thing you can have? Because even if you don't use it every month, every year that that thing stays open, you can stretch out your open credit history. Those cars that you get and you pay off, payday loans that you pay off, those things like that, furniture that you get and you pay off on installment plans, as soon as they close, you lose that credit history.
So I have a question. So like at the bank, they have like a signature loan, and you get them for a long period of time, and then once you pay it off, it's good to get another one right after that too.
No, it's bad.
It is?
Yeah. And I know what they're trying to sell you on. You're establishing credit. You get something open and then another person wants to give you more credit. But here's the problem. That average credit range, like I have stuff on my credit that's like a 10-year. Like I have a Capital One I've had for 10 years, right? But you're like, you have a 10-year Capital One, so why doesn't it say your credit history is 10 years? Because I do have a 10-year Capital One. It don't work like that. It's an average of everything that you have open. So the reason mine is the red right now, and I'll tell you why. In 2019, the house that I lived in spring, I had it probably for like, I don't know, 12 years or something like that, the mortgage, right? I refinanced it in December of 2019. So I lost over 12 years of history because I wanted to get a low rate.
Wow.
That thing started all over again. So now if you look at the new mortgage, I barely have 2 years on that. It dragged my average down.
Oh, really?
Yeah. Yeah.
That's not fair.
So
Yeah.
people that's financing, refinancing now, if anything holds.
Yeah, and their credit drops.
Oh,
Yeah.
wow.
Yeah.
If you got your house.
So then I have a cons account, right? So we got this fancy office that we opened in the midst of COVID, right? So I go and like cons like, hey, we'll give you a nice TV with no interest for 12 months. So guess what I did? I got this TV on cons, right? So guess what happened? It dropped my credit. You see? So when you're about to buy a home and the loan officer tells you, don't open any new credit. There's 2 reasons why he's saying that. Number 1, don't get new debt because whatever monthly payment you're going to drop and how much you qualify for. But also that 79 points based on all the open stuff. So for example, let's say you only had one open account and it was 10 years, a 10-year credit card. And then you went out and you went and bought a car. As soon as that car hits and it's 1 month, you got to add the 10 years plus the 1 month. You got 10 years and 1 month and divide it by 2. You just dropped 5 years from 10 to 5. Yeah. That's the most overlooked part of the equation, because people are like, hey, if you're gonna get, like, every time you go shopping, don't they ask you, hey, you want to apply for a credit card? Every time you apply and you get approved, you just drag your average down. So sometimes it may be better if you're the person with 15 department store credit cards and you just opened 6 of them last year, just close them. Right? Unless you want to wait 4, 5, 6, 7, 8, 9, 10 years in the future to rebuild that credit history. Okay? So if you don't have any credit card, you should get one, because in 10 years in the future, you'd be happy you did, as long as you keep it open.
So long as it's open without a balance and you ain't even using it, it's just open. Does that hurt anything?
No, you know how many people had like Montgomery Ward credit card for 20 years, and then Montgomery card went out of business and they still had the credit card? And that's like everybody's parents had 800 credit score because they have these credit cards of companies that don't even exist anymore. You see, so the thing is, a credit card will stay open until you do bad by it, or maybe the company goes out of business. Now, they may say because you're not using it, like Ashley Furniture, they hit me all the time. Oh, we love you so much. I don't even use the card. I open it just in case one day I may have to use it, but I built the credit line, right? So they'll send you promotion. When they start sending you promotions, it's because they know you got the card and you're not using it. So you might go in and just buy a pillow or something like that, pay it off, just, keep activity on it. But the goal is get yourself a minimum, I would say 2 at a minimum, credit cards. Keep them open forever. Why 2? Because when you go apply for a mortgage, FA guideline, 2 open accounts, no late payments in the last 12 months, right? If you had a car and you paid the car off last year, a year ago, you can't use that account because it's outside the 12-month window, right? Well, I had a car and I never made late payments in 5 years. Well, you paid the car off a year and a half ago. They don't count. So keep 2 open accounts at any given time. And the thing revolving is stay open forever. Okay, so you can always fall back on those cards. And that's another reason why when you need to get a quick boost in your credit and you add, get added to your mama's credit card, piggyback off your mom's card because she got a credit card for like 15 years. That's why it really helps, is because you're getting that longevity. And of course, if she has the balance down, if she has it maxed out, then don't get on your mom's credit card.
Let's say you are opening a new account, no credit card specific recently, and you want to buy a house. It's better for you to pay off that one that is recently versus a one that you had a long time ago.
It doesn't matter how long the revolving credit is open. What matters is what's the balances across all of them.
Okay.
Yeah. So then the argument is, which one do I pay down first? Is it going to help me more? It doesn't, right? So then you just fall back on which one has the most interest on it. Pay that one off first. Because regardless, if you're paying one of them off, it's lowering your ratio across all the balances.
But if you keep an account open for a long time with $0, they will eventually close it if they have a new one.
Yep, sometimes they will. So that's why, just maybe charge it up here and there. Like Ashley Furniture, they're expensive. I'd rather go to Bale Furniture, right? But Bale don't have a credit card. They just do the in-house financing deal, right? So, but I have the Ashley Furniture because sometimes they, Memorial Weekend sale, you just never know, right? So they'll send me stuff saying, hey, you're a good customer. I'm like, I don't even use your card, right? But I would use it when I start to see that they're harassing me to use the card because I don't want them to close the card. So just, so here's the thing. If it's a bank card, not a department store, a bank card, put gas in your car with it. Don't use your debit card. Get a rewards card from your bank, right? And even if you have a card from your bank, see if they can convert it to a rewards card using the same account number so that you don't lose that history. And then just charge gas and then pay it to your bank account. If it's a department store card, if it's something that you're never gonna buy, right? Then, maybe don't renew it because, they do have an expiration date, right? So they'll send you a new card. That's probably what they did. It expired and they probably didn't send you a new card and they just cut it.
Probably.
Yeah, because remember, credit cards have an expiration date. So they may just not reissue you a new one. So the other thing is, when you get your credit cards to go above $5,000 limit, you do get a little bit more points. So if you do have a credit card, always try to work on increasing that limit above the 5,000 mark. You do get a little bit more points if you can do that as well. And when it comes to credit cards, here's what I recommend, because I got laid off from the first job I ever had when I got out the military, right? And let me tell you, when you have a mortgage to pay and you ain't got no money coming in, right? You'll take whatever job they give you. That's how I ended up at Best Buy in Katy and Bassett Furniture across the street because I had no choice, right? And even I went to Walmart for $7.50 an hour, but they're like, you're overqualified. So I know what it feels like to have a mortgage due in a couple of weeks and you're willing to take anything, right? If you have enough credit card limit where you can technically cover 3 months of your income, because most things that you pay, you can put on a credit card, right? Maybe not a mortgage, but you can always ask for mercy, right? But there's other things that you can technically put on a credit card. So if you have 3 months, so if you make $3,000 a month, right? Get all your credit cards to a limit of 9,000. So in the event something happens on your job and you have to get out there and interview, you got 3 months that you can still pay your bill. Yes, it's going to be on credit cards, but you don't want to miss the best possible job that you can get because you're willing to take the first thing that came along. That's what happened to me. I got stuck in these jobs, working them, 2 jobs, working at Best Buy in the morning, Bassett Furniture. Hated those jobs, but what are you going to do when you got to pay the bills? Mix of credit is having different types of credit cards, mortgages, cars, things like that. So if you have a car, but you have no credit cards revolving, just by adding credit cards to the mix, you can get some points. The total points you can get is 53 points by mixing it up. Okay. Now the last one, number 5. This one is a little bit different than the other 4. Okay. This one is those credit increase. I call it the grace factor because you get it without having to do anything, right? So you're going to get 53 points right off the bat, but you will lose those 53 points every time your credit is pulled within a certain time frame based on the industry of what you're shopping in. So if you go to the Lexus dealership over here and they run your credit, right? As they're using the auto FICO system. They pull your credit, let's say you go down 3 points. Go a little bit further down to the Acura. They pull your credit the day after. You're probably not going to go down another 3 points because why? You have the right to shop around and get the best rates. So it's not like, hey, I'm going to spend 4 different days shopping for a car. 4 different people are going to pull my credit and they're going to hurt me every time I pull. No, it doesn't work like that. Okay. Now, if you go to the Lexus dealership and they pull your credit, and then you drive up here and you apply for a mortgage and we pull your credit, it's 2 different industries. So you probably will drop 3 over there and you'll probably drop up to 3 over here. And then apply for a credit card. Yeah. And then you go to the Woodlands Mall and you apply for a credit card. So that's going to be another probably 3-point drop. But here's the good thing. The increase legally can stay on your credit for up to 2 years, right? So as the 2-year mark comes, then guess what? They start to fall off. All right, so if you want more information on our credit enhancement program, there is a link at the bottom that you can go check that out. That's our free credit program. All right, so we already talked about step 1. We talked a lot about that because it is the most important step, that you gotta understand how credit works before you go and try to get yourself a full-blown mortgage, right? Because at the end of the day, that mortgage person might say, well, hey, you're good to go right now. Let's just go, shopping, right? But you need to optimize your credit to make sure you can get the best loan. Low rates, low down payment, and can qualify for the most that you can qualify based on your income and your current debts, which we may have to restructure your debts to get you qualified for even more. Okay. So that brings us to step number 2, the mortgage. This is the part where people sweat bullets, right? Because when you have someone saying, I need your social security card, I need your driver's license, I need your visa, I need your bank statement. Oh my God, if someone gets my bank statements, they're gonna look at my lifestyle, right? You can tell somebody's lifestyle by looking at their bank statements, right? Like, hey, you eat at McDonald's every other day. Wow, okay. So, you know, so be careful where you're using that debit card if you don't want to be embarrassed about some stuff, because we got to get the last 2 months of your bank statements, okay? So, and also pay stubs. So if you try to say, oh yeah, I ain't got no debt, and then you're paying child support, and we look at your pay stub and they withholding that, there's no way you can get around. You can't cheat the system, because a lot of time is reported on your pay stub. So that's why I say people sweat bullets, because it's like, oh my God, I got to give you all my personal information, right? So that's why we need to make sure that before we get to that process, we're on the same page before we move forward, okay? So what do banks look at in order to approve me for a loan? We just beat credit score to death. Yes, it's a certain number that once it goes into the computer system, the computer can give an automatic approval, which means pretty much every bank's gonna approve you if they give you the automated accept, because it's a standardized software that all the banks use. If your credit profile is not strong, then what's gonna be called is called a downgrade or a refer, which means a human being is gonna have to give you the thumbs up. And because it's more risky, then that bank is gonna wanna charge you more, okay? Or ask more of you. For example, because your credit score is a 580, we'll approve you with the 3.5% down on FHA only if you can prove, based on your savings and your retirement or anywhere else where you got money, that you got 3 to 6 months of your house payment in reserves. That's what you call a compensating factor. We'll approve you, but you got to have 3 to 6 months of your house payment in reserve. So in the event you can't pay your mortgage, we know you got the money somewhere, okay?
So you got a brokerage company.
Mhm.
So if they doesn't get the automatic approval, you send it to the human.
Yeah,
You send it to
so-
the human. So you got some connects with some underwriters that's
Yes.
favorable to you.
Yeah, so more than just connects, we have contracts with them, and we have their software. So when we run it through the automated underwriting software and we get the automated accept, we have, it's called findings, right? We can upload it to their software and they have to accept it. Now, if our software, which is also connected to the government, says that it's a refer or it's downgraded to be ineligible, then out of the 9 banks we have 2 or 3 of them that will do a manual underwrite. Not every bank does a manual underwrite. Like if you have Chase Bank forever and you got a lot of money, they don't do manual underwrites, right? They're like, no, either computer says you're good, because here's why. If the government's computer system says you're good and then you default on the loan down the road, there's no chargeback to the bank. But if the computer system from the government says you're not good and the bank says we're going to take a chance on you, and then 2 years down the road you default on the loan, they may have to be penalized for that loan, right? Have a bad loan on their books. So that's why a lot of banks, they don't do manual underwrite, because they're like, we're not going to be on the hook for this. And that's why if it is a manual underwrite, they're going to get a lot more money out of you in that interest, because it is a more risky loan. Okay. So yes, we do have several banks that we have contracts with. And the reason we have several banks is because not every bank does every type of loan. Okay. So we want to make sure that we have a buffet of different types of loans so you can be exposed to the most type of financing that's available. Okay. All right, so we spoke about monthly income and debts. So income, what is that? It's what you're getting paid from your job legally, right? That can be documented. And there's 2 ways people typically can get paid legally, is W-2 or 1099 contractor. Anybody in here 1099 contractor? Which another word for that is self-employed, right? Like a truck driver might be 1099. He gets an order from a company to go to this part of the world to pick up this thing and bring it over there. And when you do your job, they pay you a set fee because you did that job, right? So if anyone is a 1099 contractor, you got to show 2 years that you've been doing that position by evidence of tax returns.
Okay, in any case, if you're doing a 1099 and you had filed taxes,
Oh, you're gonna have to file
in
tax.
2 years, I could go longer, just do it.
But they shouldn't be going longer.
So,
You gotta give Uncle Sam his chunk.
so if you hadn't filed, I mean, I'm not so, so if you hadn't filed, you can't get a house.
You can, but you gotta go backdate your taxes. You gotta do 2 years back taxes. Yeah, and we got people that can do that for you. Yeah. So the thing is you gotta show proof. It's called the ability to repay, right? That's an actual legal term. Because after the bailouts of the banks, the government's like, why you give all these people loans? When you know they didn't have the ability to repay. Well, the government, you told us to give everybody a house, so we just made it so lenient that, hey, we don't have to look at your pay stubs, we don't have to look at nothing. You got good credit, we'll give you a $1 million house, right? So now the government has what's called ability to repay, right? And if a bank can't prove that you have the ability to repay a loan, they're gonna get fined. So the ability to repay is, they got to look at all your income information, okay? So again, if you're self-employed, either you own a business or you're a contractor. See, there's people that own like, KFC, they're self-employed, right? They're not getting a 1099. They actually own the company and probably do get W-2, but they still are a business. So they got to look at their profit and loss, right? But someone who's an independent contractor, like a real estate agent, can be an independent contractor, right? Your income can go like this, right? The housing market is kind of like this right now, the shortage of homes. So that person's income could take a dip. So they want to see 2 years and average your income over that 2 years. So if you had a bad year, that bad year averages in your monthly income, because that's what they're going to do, divided by 24 months. Okay. If you're W-2, they'll just go by the gross income that you make. Okay. So if you make $50,000 a year, you get credit for $50,000 a year divided by 12 months is what they're going to look at your monthly income to determine how much you're going to be able to qualify for. Self-employed people, let's say you make $50,000 2 years in a row. That went into your bank account. But then those 2 years in a row, you wrote off $25,000 in expenses. So what they're going to do is add up the 50,000, that's 100,000. And then they're going to subtract the expenses, 50,000 over the 2 years. So in reality, you make 50,000 and then they're going to go ahead and divide it by 24 months. So at the end of the day, you make 25,000 to qualify for a home. And that's going to be tough doing that. Okay. So if you're a 1099 contractor, self-employed, when you're ready to buy a home, you need to make sure you're not writing off everything that you shouldn't be writing off 2 years prior to when you're going to buy a home. Okay. And we have a government form that we can calculate self-employed people's income. So you can't cheat the system with that. Okay. Now we do have a loan program if you are self-employed and you don't want to get a government insured loan. There's other loans that are not government insured. We have one that's called a bank statement loan. So if you say, well, I've been driving a truck for the last 12 months and I know I'm putting $10,000 a month in my bank account, you can provide your bank statements to show that 10,000 and they will give you a good portion of that 10,000 as a credit towards the purchase of your house. Okay. But that's not a government insured loan. Okay. All right. Other income. If you get SSI, get disability, or you get any type of child support, you can count that, but you got to show proof you're going to be getting it for at least 3 years from the day you move in. Okay. So if you got a child, let's say 17, and he's going to be graduating at 18, and you're not going to get the money once he turns 19, then you're not going to be able to count that. Okay. Rental history. Rent history is the most similar thing to a housing payment. So of course the bank is going to look at that. If you've been late on your rent, then what's the chances that you're going to be late on your mortgage? So in the last 12 months, you cannot be late on your rent. Now here's the thing that's different about rent. See, when you have a credit score, you're not technically late until you're 1 full month late. If you're paying rent, it's due on the 1st and then late either on the 3rd or the 5th, right? So if you keep paying on the 6th every single month, and even if you say, well, I'll just pay the late fee, right? Then you technically will be late 12 times in a year. And you're not gonna be able to get a house. So if you are renting, do not push the envelope. If they tell you to pay on the 1st, pay it on the 1st, okay? Because when they go and send that government form to your landlord, have you ever been late in the last 12 months? They paid on the 6th that month, they paid on the 9th that month, and they paid on the 12th that month. 3 times late in the last 12 months. Okay, so it's not 30 days late. It's whatever the apartment people put on there. So here's another thing about rent. Does anybody rent from a family member? Okay, nobody, okay. Let's say you did rent from your mama. Whose mama wouldn't lie for him? Right? Mine wouldn't, because mine's a Jehovah's Witness, she don't lie. Nobody. She'll throw me under the bus quick, right? Mama don't play. So here's the thing. If you rent with a family member or a guy named Joe, right? Or Tim, these are just average people say, hey, that's my house, and I'm gonna rent it out to you, right? And typically, hey, don't even worry about the contract, we're paying cash, right? The government don't trust these type of people because why? They were lying, right? So if it is a guy named Joe or it's your mama, then however you pay, you need to prove that you pay through documentation. The best way, if you go from your bank account to theirs, great. You write them a check and then you keep those canceled checks, which are on your bank statements every month, and put the word rent, okay? You technically could do a money order, but if you take 1,000 out of your bank, then they'll ask you, let me get the bank statement, seeing where you took the 1,000 out, and then let me see the copy of the money order that you gave to mom or a guy named Tim, okay? Now, if you rent from an apartment, that's a legitimate business. Or if you rent a house that's managed by property management, that's a legitimate business. They have to take their word for it, okay? Work history. The norm or the standard is you gotta add work for 2 years, okay? Now, I understand sometimes women have babies. My wife had 2 in the last 3 years. So, but she still worked though. But sometimes there's women that don't work. They take off for like 6 months. Don't be afraid to say, well, I technically didn't work 2 years because I took 6 to 9 months off. That's okay. That's excusable. No big deal, okay? Or you have one job, 6 months, and then you jump to another job and you do a year and a half. That's okay that you work different jobs because you worked 2 years by evidence of your pay stubs and your tax returns and your W-2s. They can paint a picture by looking at your W-2s, right? Now, there is an exemption. If you're a college student or anybody who went to go get more training and you were focused on getting your training, thus you couldn't work, as long as you have some type of certificate, degree, or transcript that show that you were a student, they can waive the 2-year work history. So for example, you could be someone who graduated high school and then you went straight to a 2-year RN program, right? So for that 2 years, you never worked. And now you're like 20 years old, making $17 to $30 an hour on salary because you got the contract. You can actually buy a house, even though you didn't even start working yet, because you have the contract and you show proof that you went to school to get that degree. Okay, I have on here ability to save money, which we call reserves. A person who's trying to buy a house should not be buying a house and the day you move in, you have $1 to your name, right? That's just not smart, right? So if you have at least 2 months of your house payment in a bank account, your 401k account, anywhere where you can put money, when we enter that into the algorithm, the automated underwriting system, and we got 2 months of reserve, you're gonna have a little bit more favor with getting your loan. Because here's the trick. When you move into your house, whatever day you move in, right, you don't pay your mortgage payment that month. So if you move in June 5th, you don't pay a mortgage payment. You get to live pretty much for free for the month of June. Then you skip another month. right? You remember when you moved in, you skipped a month? Remember when you moved in, you skipped a month, right? So based on how you time it, you almost might get away with living in a house for 2 months without making a payment. So you have 2 months reserves in a cushion, plus you should be saving some money, at least 1 month of not having to pay that mortgage. So theoretically, you should be able to have 3 months of a house payment by the 30 days after you've been in the house. So having the reserves, it just makes the algorithm say this person saves, and it's not as risky of a loan because you have a cushion put aside. Okay. Always have a vehicle to put money aside that you can't easily grab. There's a good way you could do it. Anybody invest like in, I don't know, a Roth IRA? Anybody got a Roth IRA? No, that's something anybody can set up if you have a job. You don't even have to have it with your company. You just set it up. You can put up to $6,000 a year into an account. So if you just say, I'm going to put $300-400 a month of my paycheck in my Bank of America Roth IRA, right? And just transfer the money in there and then just let it sit. You can invest in some stuff if you know how to do that, but just let it sit. It's harder to get that money out, okay? So if you have some type of savings account that's not your bank account, because you put in your savings account at Bank of America, probably you can get that money with the same debit card as your checking account, right? It's just so tempting to get that money. So what you got to do is set up a plan to put a couple $100s a month in a place that you don't look at every day. Okay. So by the time you're like, hey, I got 2 months of house payment saved right there. Now, if you invest it in stocks and bonds and things like that, then that $200 you put in may have turned into $300 at the end of the year, and you're doing it every single month. Okay. So what I try to do is always put money in one of these little side accounts that gains a lot of interest, way more than what banks do, to equal at least 6 months of the house payment. It is harder to get the money. Yeah, you probably pay some tax penalties because it is your retirement, but on paper, it looks good to the banks, right? They know that you just can't pull that money out. And if you do, you're gonna get penalized, but it looks good on paper because it asks, does this person have reserves, bank account, checking, savings, retirement, 401k? Boom, let me see your statement, you put it in, you're good to go. How many people bank with Bank of America and Chase or Wells Fargo? They're like the big three, right? So a lot of times we're loyal to these banks because they got our checking and savings. But then when you try to walk in and get a mortgage, and they're horrible because mortgages is not their primary business. Checking and savings is their primary business, right? And CDs and things like that. So a lot of people, they get confused because I've been with this bank for so long. So it seems like it's the right choice that I use them to be able to do my home loan. And typically they're the first ones that turn me down because that's not their primary business. I can tell you Bank of America, one loan officer typically is working 3 different locations, right? So good luck. Like walk into a Bank of America and ask them, hey, do you have a mortgage? They got mortgage stuff all over the walls, but ask them, where's the mortgage loan originator? Oh, he's not here today. We'll give you a card. You got to make an appointment with them, right? So how do you know which lender to be able to get money for your mortgage? Well, it's very simple. Those banks are called retail, right? Those are the ones that got the storefronts on every corner. They got a bunch of employees. They got a bunch of overhead expenses because they got the buildings. So look at it from the perspective of if you go to the store at the mall and you're like, why does this same thing cost $5 more in the store at the mall, but then I can go over to Mervyn's or go to Ross, buy the same thing, and it's a lot cheaper. Because look at the overhead that Ross have. It's just a big old box, right? Big old box, probably 1,000,000 times bigger than these little stores at the mall, and they don't have as much staff as well. So the thing with banking is when you go directly to a bank, which is retail, they have a lot more overhead. So that means whenever you shop for a loan or products, they're going to mark up the interest because they have to pay all the bills. In our business model, we're a mortgage broker. We're not a lender. I can't give you any money. I have no money to give you a home loan, but we're connected to wholesale lenders that they don't have buildings, like big buildings on the side of the street. Like we have one that's in California, there's one that's in Colorado, there's one in Florida, right? So these are banks that only do mortgages and they service the loans, which means these are the ones that you can have a loan for 30 years with them. And every time you pay your bill and you want to talk to someone, you're talking to their people, right? That's all they do is just lend out money. They don't have a bunch of branch offices. They contract with local mortgage brokers where we find people that will be a good fit for a loan. We do all the upfront work. They just look at everything and say, okay, here's the money. It'll be in the title company on this day. Okay, so we do the legwork, but they're really the investor. They don't want to just give you the money. Okay, so wholesale lenders don't have as much infrastructure, so their rates are going to be a lot lower. So our rates with our lenders typically are going to be 1% lower than if you walk into retail. Okay. Plus, if you walk into Wells Fargo, you can only see the loans that Wells Fargo has to offer. With us, we have 9 different banks, so we can show you what 9 different banks have to offer. Money is money. The difference is the rates and the fees that they charge during the application process. That's really the only difference. Can I add someone else to the loan? And I'm reading this question because these are questions that we hear a lot. Can I add somebody else to the loan? We get that a lot because when people buy cars, especially if you're young, you typically got to piggyback off your mom and dad's credit, right? You can do that when buying a house. Especially we see it a lot when it's 2 different generations living in the house. Mom and dad, and then their kids work. And their kids are like, I ain't leaving the house, right? So they're saying, because you work, why don't we use the kids' income for the loan so we can qualify for a bigger house since my kids are going to live in the house anyways? The great thing about that is you're helping your kids' credit by putting a mortgage on their credit report. In the event that they ever want to go get their own home loan, they've already got a track record of having their name on a mortgage. Okay, so you can add someone, but here's the issue with the state of Texas. Anybody ever heard of a community property state? Heard that? What does that mean? Okay. So here's how it hurts people in Texas. On FHA loans, which is government insured, let's say you have, and I'm gonna flip it around so y'all don't say that I'm biased. Let's say you have a stay-at-home dad, right? Wife's working, making good money, right? Husband has good credit. Well, I want to put him on the loan, right? But he don't make money. So you don't make money. So how are you gonna have him on a loan to help you qualify for more? So the thing is, even though he may not be on the loan, because you married to him and he got a $650 boat payment on his credit, you got to count that debt against the wife who's on the loan. Because any debt you have, they join it together. Okay? So that's why if anybody's thinking about getting married, pull the credit of that other person first. Because let me tell you, I don't want to be the one that had to break the bed and, oh, we just got married last week and now we want to buy a house. I'm like, you know, he got like $50,000 worth of debt. So you're not going to qualify for much. And they're like, well, why didn't you tell me this before we got married? Because you didn't set an appointment with us first. Sometimes you got to get the house first and then get married. Have the reception in your new house, right? So that's one situation where you have one spouse or partner who's not working, but they have debt. The other one is you got the spouse that is working, but because their credit is so bad, they cannot be on the loan to help the other person to qualify for more. And because they have that debt, it's going to count against the one who's going to be on the loan. Okay, so we hear it a lot. We want to buy a home, but we're not going to put my husband or wife on the loan. That's fine. We still got to pull their credit because if they have any debt, it automatically counts against you as well. Now, this is legal marriage. If you say we've been living together for a year and we're common law, which is like another Texas thing, right? Common law, then that's really not like legal marriage when you're trying to get a loan. But here's where the problem comes in. You go to your tax guy and he says, hey, use me and I'll give you more money. Y'all been living together? Yeah, y'all common law. So what we're going to do is tell the IRS that you're married and we're going to file your taxes joint. right? So then you come in with your taxes and one person we can't use, and we're like, well, we got to count his debt because why? You guys told the IRS that you married. So you can't back out and say, oh, no, we didn't get married by the courthouse. But you know what? You told the IRS you're married. So either you commit mortgage fraud or you commit tax fraud. Which one?
Wow.
So if you know anybody that says, I'm married because we've been living together and sharing bills, yeah, don't file your taxes joint. It is going to come back and bite you. Okay? All right. Any question on mortgages? All right. You see how that one's very stressful? It's a lot of moving parts to mortgages. The guidelines for FHA is a book that's that thick, right? It's thick. That's why you need to work with a mortgage company and loan originators that know their stuff, just for FHA. And then VA is for military folks. It's just as thick, right? So a lot of that stuff is automated, but with experience, we can hand walk you through the mortgage process as well, okay? And remember, we're not against you, we're for you. So if there's things that are confidential and you want to keep it between us, not a problem. We're not going to be against you. We don't work for immigration, right? We're not going to call anybody on you. We're not going to call the IRS. That's not our responsibility to be able to do that thing. But we will tell you, you know this is a red flag, right? And probably you need to fix this before you move forward, before you dig yourself a deeper hole, okay? The last step is the buying of the home. This is like the best step of the process. All right. So first question, what's the difference between a real estate agent and a realtor?
Realtor's gonna help you buy a home.
Realtor's gonna help you buy a home?
I mean, search for a home.
Realtor's gonna help you search for a home.
Yeah.
What's the real estate agent gonna do?
Right.
Same thing? Okay. Anybody else?
Is it one that's been, I mean, is the difference between who's been passed and been certified, just the certification?
Okay, so you're saying the difference could be the realtor could have a special certification that the real estate agent doesn't,
Either versa.
or vice versa.
Yeah.
Okay. That's the first time I heard that one.
I mean, you're gonna have to say, well, I gotta take my exam, I need to take my certification.
Yep.
So, you know.
Yep, that was a good one. First time someone mentioned that. Who else? That's
I
okay.
don't know which one would be which one. One works and one gives the other work.
So one is the boss and one's the employee.
Yeah.
The realtor's the boss? Okay. That's the first time I heard that one. That's good. Listen, I've done like probably 140 of these seminars, so that's good. That, you know, there's still creativity going out there. Okay, so here's the thing. How many people know what a union is? Anybody part of a union? Okay, so a real estate agent is someone who has to take specific education dictated by the state, have to pass background checks, have to take a national and state test, and if they can pass it, they will get a real estate license. And what that license allows them to do is to help a person to buy a home from another person or to help somebody sell their home to another person. So you can help a buyer and a seller. You're literally managing the transaction. You're kind of like a middleman, right? So I personally don't own the home, but I can help you buy a home, I can help you sell a home, and I can earn a commission for my services of helping you to do that because I'm helping you in the transaction, okay? You got to be licensed through the state. Each state has its own license. Now, realtor, what is that? That's like a union. This is an organization that's at the national level. How many people ever heard National Association of Realtors? Then they have the state level, Texas Association of Realtors, and then they have the local level, the Houston Association of Realtors. It's like a union that is designed for two things. Number one, look out for the best interests of licensed real estate agents based on politic type stuff, right? And also to look at the industry to make it more favorable, similar to when teachers are part of our union, and they do a walkout because of, pay and things like that, right? So it's to protect the industry. But also, the National Association of Realtors is also designed to protect the consumer and promote housing inequality for everyone in the nation, okay? So I'm a realtor because I volunteer to be a realtor. So I joined the national, the state, and the local. When you own a company, then your company becomes a member. And if your company becomes a member, then any real estate agent who works for your company, by default, they have to become members, okay? There's probably like 1.4 million realtors that are part of this association. We pay an annual fee. Could be anywhere from $500 to $1,000 a year. So it's a lot of money that's being pumped in to the National Association of Realtors. And what they use that money for is home ownership advocacy, okay? So y'all remember, like, I don't know who the housing department person is, right? But y'all know who the last one was? He's probably the most famous person in the administration, last one, Ben Carson. He had a movie came out about him, remember? Gifted Hands, the brain surgeon.
Oh, okay.
He did a lot of work in the last 4 years to make housing affordable, right? A lot of people don't even know that that's what he was doing. But when he took that position as the Secretary of Housing, as soon as he took that position, the president of NAR went from Chicago, because that's where the corporate office, flew to Washington, D.C., sat down with Ben Carson and said, now what are you going to do to make housing more affordable, right? And that's why housing started exploding over the last 4 years, right? Because Ben is very smart. He's a brain surgeon, right? A lot of programs, interest rates, remember rates were starting to go up, but then they started to go back down and people started buying houses, okay? A lot of programs came out, okay? So why do you want to work with someone who is a member of the National Association, who is a realtor? Because not only did they pass the test and have a license, but there's a code of ethics, right? It has nothing to do with the states, because this is a national, it's a code of ethics that's even higher than the local state laws, okay? So for example, if you're a member and you're a realtor, you can't go cuss out another realtor over a transaction. You gotta be nice to people, right? So there's like hundreds of things that we subscribe to when we become part of that membership, okay? So I want you guys to understand the difference, because every realtor is a real estate agent, but not every real estate agent is a realtor, okay? It's two different levels. You violate some stuff at the state level, that's the state of Texas, that could be coming after your license, right? You violate some ethical stuff, that's the National Association of Realtors, can disbar you from that association, right? So you can't no longer say that I'm a licensed realtor. You can't even use that word. They own that word, okay? Serious stuff. Now, how do we find the right home for you, or how do you find the right home for yourself? What we've experienced, once you've mastered the credit, you got your mortgage loan, and you're like, oh my God, I can buy a house now. So exciting. It's like sometimes like, oh my God, what do I do now, right? And what we've seen is people get so emotional, right? To the point, sometimes anxiety or anxiousness, right? Whichever way you want to look at it, right? Because you're like, I'm going to be a home owner, right? And the thing is anytime you move in emotions, a lot of times you may not make the right decisions, right? So how do you find the right home? How do we help you do it? It's simply this. We talk to one another, right? We keep you grounded. We're going to ask you specific questions like, why did you want to buy a home? Why do you want a 2-story versus 1-story? How many people want a 1-story home in here? Okay. Why do you want a 1-story?
I don't want no stairs. I want everything on one level, and it's easy to keep clean.
Okay. You got children?
Yes, but they grown now.
They grown? Okay. So you just don't want stairs because you believe a 1-story, it will be easier to keep clean.
Yeah.
Okay. You know, in 1-stories, typically the ceilings are so high that you can't get up to If it doesn't,
It's so bad.
but you don't even want stairs.
I had a two-story and the mistake I made when I purchased my home, all my bedrooms was upstairs.
Okay.
So if you have elderly parents or you had some, because I sold my house when my mom passed away after having it for a while, but I couldn't bring her to the house because all the bedrooms was upstairs. So that was one of the things. And now that I got older,
That's the thing,
I
right
agree.
there. That's it, right there.
I
Yeah.
So I would agree that when we do get a little bit older, going up and down those stairs probably is not so nice, right? But if you look at, for example, this is a yard, right? If you have a two-story home and this is your yard and you have young children, or you have an animal, right? When you build a two-story home, what's going to happen is the concrete slab is half of a one-story. Now, not taking lumber into consideration because lumber is very expensive. Before that was happening, what was the major cost of a home? The foundation, right? So some people would say, I want a 2,000 square foot home. They look at a 2,000 square foot one story, a 2,000 square foot two-story and say, why is the two-story 10,000 less than the one story, but they got the same amount of space? It's because the cost saving of the slab. So in reality, you could probably get a 22 or 2,300 square foot two-story, 300 square foot more for about the same price because of the price cut, right? But also, when you do the two-story, look what happens to your yard space. It got bigger, right? So for people that said, I want to be able to have barbecues in the back, I want my kids to go out and play, I want my dog to run around, but I want a one-story, by the time we get in the field, they're saying, I have no backyard for anything. And they change their mind, right? So the thing is, we have communication with you. We're going to learn your wants, your needs, and your DBM. Your DBM is your dominant buying mode. It's that emotional reason. Why? Because sometimes people make decisions based on emotions, and then they're in their house within a year, they're like, you know what? I shouldn't have bought this, right? So, and we don't want you to have that type of regret, okay? So we've helped literally thousands of people over the last 17 years to buy homes. And we've listened to what they wanted. And even once they've been in their house, they would say the next time around, this is what I'm going to do. So we're able to not just show you a house, but say, hey, based on what you said you're looking to accomplish, let's see if this house matches what you really want and what you need. And is it going to fulfill that emotional reason of why you're going to be able to buy? Okay. I'm saying this, you may not understand what I'm trying to get at, but there's salespeople out there. Hey, there's 5 houses. Which one you want to buy? Let's start the paperwork, right? And then you end up buying a house that you don't like. Okay. That's why when you work with our company, we have a clause in our contract. If you're unhappy with your house for any reason, within the first 2 years, we will sell your house for free. Yeah, we don't even charge you a listing, right? Yeah, because we know things change, right? Okay. So,
But then you have to have the new one with us.
you don't, but so the thing is when you get that approval, it's a lot of excitement. And the thing is, sometimes people, they just go off the chain, right? So we just want to make sure that we stay grounded and we're very focused because listen, you could be tying yourself into a loan for 30 years. You could always refinance, you could always sell your house. That's another thing. A lot of people don't know. You can buy a house today and you can sell it like 2 weeks from now, right? You're not going to be stuck in it, but being able to move and have a life in that house, a lot of people really in their mind think I'm going to be here for a long time, right? So we just want to make sure that you're going to be happy with your purchase, is what I'm saying. Okay, let's talk about how much money will I need when it's time to start looking for the home. This is an issue that does come up, right? It doesn't come up a lot, but when you're working with us for a period of time, we're always explaining over and over because sometimes people, they got selective hearing, right? And again, when you get that approval, like, hey, I can go buy a house now, and then we find the right house, and you got to put what's called an earnest money deposit down. Anybody ever heard of an earnest money deposit? That is a fee that you put down on that house with the contract to buy the house to secure that house and take it off the market so nobody else can buy it. Okay? Now, that fee typically, when I say typically, because all this COVID mess, there's nothing really typically anymore, right? But typically, it could be anywhere from 1% of the sales price of that home, or it could be a flat fee. A lot of times we negotiate this $1,000. That is to take a house off the market so that you can get all your inspections done, appraisals done, finances done, to be able to close on that home in about 30 days from the day we take it off the market. Okay? So when you're ready to start looking for a home, you gotta have some money in your bank account, right? So when you start working with us and we start gathering your financials, if we see that you eat at McDonald's every day and your $4,000 paycheck or whatever paycheck is like $300 at the end of the month because McDonald's, Starbucks, we're gonna have to tell you, you can't go to McDonald's and Starbucks because you're gonna have to have that money when it comes time to put your earnest money down. Okay? So earnest money is probably the biggest thing that you need to have. And just remember, it typically is 1%, or it could be a flat fee. Typically we negotiate about $1,000. That's negotiable is what I'm saying. If you buy this person's house over here, the seller may say, well, I want $2,000 earnest money. The person with the house across the street says, hey, well, I want 1% of what the price of the house is going to be. There is no set fee. Now, loan application fee, which really is an appraisal fee. When you go to buy a home, remember, it's the bank who's actually giving you the money. They actually own the house until you pay for it, right? So they want to send somebody out there to do an evaluation of the home. Number one, is it move-in ready? Is it a good house? Number two, is it worth the money that you're going to buy it for because they're giving you the money for it? So if you put a contract on a house that's $250,000 and the bank sends someone out there and it's only $230,000, the bank's like, we're not giving you $250,000. You come up with the difference in the form of a down payment, or you just cancel the contract. Okay?
New houses, do they still appraisal?
This COVID has got everything jacked up right now. Builders are like going up like crazy on the house because they don't know. They can't predict the future. There's builders that say, hey, well, you know, lumber's crazy, so we're going to mark our houses up by 10,000. And then 6 months later, when the house is done, they found out that it cost them 20,000 more in lumber. So now they go back to the buyers and say, hey, well, you know, we're going to have to eat this unless you can pay the difference. Some builders now, they just build houses, and when it's done, because they've already paid for the construction, then they'll sell it to you. So before it's like, hey, I'm going to walk in and here's the price today, and you're going to build it and have it ready in 6 months. The builder's like, I can't predict the cost of materials in 6 months. So I can't give you this price today because we don't know if it's going to be that price to build it. So it is a little bit tricky in this economy, but we work with every builder. Each one has their own way of doing business, but we're there to make sure that you're not going to get jacked over, okay? All right, so the appraisal fee typically is around $425, $500, depending on type of loan that you get, right? If you're a military VA, sometimes it could be up to $600. It just depends on the bank, okay? So make sure you have the appraisal money. Inspection fee. Now, I know I have $275 on here. We got to update this because even the cost of inspections have gone up, but it's really based on the size of your house. I believe the last person we had did an inspection probably came in somewhere around like $375, $400. But this is someone that you hire who represents you, that has a license through the state of Texas to be able to pick houses apart and tell you all the bad stuff that's happening, or they can tell you good stuff too, right? So, but the thing is, you want to know before the day you obligate yourself to that loan and get the keys, you want to know if it's a good house. Okay, and we have a list of inspectors that also we can give you. That folder that you actually have, we put some of these third-party companies in there. Now, option period fee. This is something that's unique, at least I believe it's unique to us here in Texas. We are licensed in Florida. They don't have this in Florida. But an option period fee is a due diligence fee. It's a small fee that you pay, for example, $200, and you buy you some time. Let's say, for example, 7 days. Because if you're putting $3,000 down to secure this house off the market, right? And you're doing your inspections. What if something's not right and you decide, I don't want to buy this house? You want to get that $3,000 back, right? Because remember that deposit that you put down, it made it where nobody else can buy that house. So if you take that house all out of inventory for 30 days, and there's 10 other people that could have bought that house, that seller could have lost another opportunity, right? So you give $3,000 to make sure nobody else can buy it while you do your due diligence. But that due diligence fee, for example, $200, it gives you the right to just cancel that contract for any reason and get your $3,000 back and just walk away. Okay? Now, we do that on every resale. The builders, they don't have that. But if you buy a used home, then we're going to recommend that you buy a due diligence period fee because you never know, something could go wrong, right? But a lot of times we'll use it when you find two houses that you like and you just don't know which one is the best one. You can't know which one's the best one until after you do your inspection. You may say, this is my perfect home, and then find out the AC's bad, it had mold, and pipes broke, and you just don't know until you get your inspection, right? So what you do is you can lock both houses up, put the earnest amount money down on both houses, right? Put your option period fee, and then once you decide this is the right house for me, you can cancel on the other one and get your earnest money back. Make sense?
Yes.
How many people knew about an option period fee?
That's the only thing I really agree down to talk about. That.
So then you got your money work today coming.
Yes, I did.
And it was free, so you didn't pay nothing, so.
I did not know that.
Yeah, that's not something that's standard around America. I can't speak for other states that I'm not licensed in, but I am licensed in Florida, I'm in Texas. In Florida, for sure, they don't do that, okay? All right, so we pretty much talked about the upfront cost. What I'm saying is, when you get approved for a loan, don't say to yourself, whoa, I got $250,000 money, I'm gonna go spending, right? No, that money, you don't get it until the day you close. But there's money involved during the process, and you gotta have that money to be able to continue that process going to get that $250,000 from the bank to pay for the house, okay? And by the way, if you got kids, I think starting next month, that stimulus check's supposed to give you like $300 per kid every single month, I think until the end of the year. Okay, so hopefully you guys, if you do get the money, save the money up. That's a lot of money if you got a lot of kids.
Yeah.
All right, so how long is the process, and will the process be easy? So there is no one answer. We have people that come to us that say, literally, I'm going to be homeless in 3 weeks because my lease is up, right? That person probably waited to the last minute. We will try to move as fast as we can, but buying a home, it is regulated, right? There's certain things you can't bypass. If you got to get a loan, you can't just get a loan today and close on a home tomorrow. It ain't gonna happen. So we tell people at a minimum 30 days, if you have the credit right, and you got the job history right, and you got the down payment right, and we find the right home. Because at the end of the day, you can have a loan, but what if it takes you 2 months to find the right home? Okay, so in a perfect world, everything's right, you find the right home, you technically could be in your house within 30 days if you're getting a mortgage. If you're paying in cash, probably 7 to 10 days if we find the right home. And it has all the inspections and everything come back good. Now, if you say, I'm on a lease and I'm gonna be on the lease, I don't know, 5 months, 6 months, a year, then you have time. We always recommend, let's give you a free credit analysis right away because we can identify strengths and weaknesses in your profile, right? So that if we have to work on the credit, move some money around on your credit report to get you in the best possible position, you don't want to wait till the last moment for that, okay? So we have a team in place that can help guide you over long periods of time. For example, Mr. Brent in the back, right there. He's the manager of our credit enhancement program. And again, credit enhancement is not just simply credit repair. There's people that have, 620, 640 credit score. They're just not ready yet. So we say, we have time. Let us even get into your credit and just make it even stronger. So by the time you are ready, you're going to be in a stronger position, okay? All right. So we got some folks coming in. It must be my time's up. So what we can do, right, is no matter what situation you're in, the starting process for us is we always give you what's called a free credit analysis. And it's really very simple. It's two things we're going to find out. Number one, what type of programs you qualify for. Now, if there's a situation with credit or something like that, then immediately we're going to get you over to Brent. So then we can take care of what we need to take care of and get you the most programs you qualify for. So that's the first thing. Find out what you qualify with the different programs. Number two, determine your purchasing power. You don't want to start the process and say, I got to buy a house next week to find out you only qualify for 110. So the purchasing is looking at your income and your debt and figuring out how much you can get qualified. Because once we have those two things figured out, then you'll be ready to go into the mortgage process. Okay, that's what we call our free credit analysis. It's very simple. I know he's got some forms to fill out. We're gonna also email you guys the form. People that are out in Zoom, if you see me keep looking at this camera, it's because we do got a bunch of people on Zoom, right? I'm talking to these people too. So we'll go ahead and send you guys the Zoom people that as well, okay? So before you go, Brent will give it to you. If not, you're gonna get an email anyways. But what I'd like to do is kind of introduce you to our team here. So how are we, I know you guys are saying you guys are different than a lot of real estate companies and realtors I spoke to before, but here's what really makes us different, okay? Our business model is we operate as a team. So any person who becomes a client of our firm, you're gonna work with multiple people based on where you're at in the process. So if you need to go into the credit process, you're gonna be working with our credit department, which we have 2 people that work in that department, okay? If you're in the process of wanting to get started and you need more information, then you'll be working with the lead agent. For example, my wife, Millie, she's a lead agent. I'm a lead agent. Our lead agents, if you guys have this there, are real estate agents that carry a special license. It's a broker's license. It's the highest license you can have in real estate, okay? In the state of Texas, you gotta have 900 hours of education, 4 years in the business, never got in trouble, right? So it's like the highest you can get, right? So we believe that if you're gonna work on buying probably the most important sale of your life, right? Like anybody gonna buy something that costs more than a house, right? So you need to work with someone who's experienced and has knowledge, right? So that's why we make it where if you wanna work with us, you have to go through one of our experienced brokers, okay? Once you get qualified and you've gone through one of our brokers and we know that you're ready to buy a home, once you're ready to go out in the field, you're gonna be working with a showing agent. We have 3 showing agents, okay? There are 2 of them out in the field. This is Mr. Teddy. Their job is to take you out to look at homes. Now they look at, like, how many houses you see in a week?
Whew. I see 5 houses pretty much every day, at least.
So when you need someone to track down a house for you, that's all they do is track down houses, not just houses. They network with every home builder in 9 counties. So if you're like, I want to buy a new home, but I heard there's a shortage, where can I go? They're gonna know exactly where to go because that's what they do. They smooth with the builders every week as well, okay? And it's a great thing that we have 3 of them here because sometimes you may work with an individual real estate agent, right? And they may say, well, I don't have time to show you today because I have another client that I'm working with. How does that make you feel when they put you to the side? Knowing that you purchasing the biggest thing that's probably gonna be life-changing for you and your children, right? So that's why we have 3 of them that are dedicated to taking you guys out to see homes, okay? Now, you guys probably know Miss Hilda. Anybody recognize that voice or name?
Hello.
Okay. So Hilda is with our client support team because we know that real estate agents in the field, they get busy, right? Lead agents, we get busy with the amount of people that want to learn about our services, right? So what our client support division does is they're like the glue that's connected to everyone on the team so that if you have questions, they can answer them right away. And if they can't, for example, you have a mortgage question. She's going to be the one who sets up a callback from one of our loan originators to call you at the time you want to be called. right?
Right.
So, oh, there he is, hi, okay, there we go, Mr. J. So we have two of them, right? So 7 days a week, these guys are operating, and so when you guys were invited to the seminar, you probably got a call saying, hey, are you gonna still come, right? That was these guys calling, right? So you're gonna have access to them, so in case you need something, they're gonna be on standby to be able to assist you, okay? Now, once you do have your house on contract, the biggest time frame in the process, it is the time from when you're on contract to the day you get your keys, because you got appraisals, inspections. The bank has to look at the paperwork on that house to make sure it's gonna be a good house that you qualify for, right? So during that time frame, when all this stuff is happening, right? We have a transaction coordinator, this is Jessica, who's keeping you in the loop, is keeping the seller in the loop, the mortgage people, the home builder, the inspectors, the appraisers. So any person that's involved with your transaction, she's the one that makes sure everything goes very smooth. Okay?
No pressure.
No pressure.
You have to like it.
Yes. So this guy hiding behind here, he's the office manager. So he's the one that set up all this nice stuff here, make sure that everything runs smoothly here. And we got someone that's not here with us today. She's actually moved to East Texas. This is Lacey. She's our marketing department. All these fancy stuff you guys are holding, she's the one that designed that. All the seminar stuff we put out on social media, she handles that. And then here is, and we're missing, this is kind of, oh, we got another guy.
We're online right now.
He's online, okay.
Yeah.
So if you're on Zoom, then probably Dustin Thompson is on there. He is
Answering
the
questions.
operations manager of the mortgage company, and we have Mr. Todd. He's our mortgage loan originator. Massive amounts of experience. This guy eats, sleeps, and breathes mortgage loan. That's all he does is home loans. Now, Dustin being the manager, he's someone that fills in the gap because again, loan officers are juggling loans, making sure that everything is turned in a timely manner so that you can close on time and get your keys, right? Because you got your stuff in the U-Haul waiting to move in, right? So he's gonna make sure that everything runs smooth. But in the event that you need questions answered or you need to get checked up on your file, you can reach out to our ops manager because he has access to everything on the mortgage company side. So he's also kind of like our liaison between the mortgage company and our clients as well. Okay, did I miss anyone?
Like Karen, which is big.
Karen, she's not here. She's the one that works with Mr. Brent in the credit department. So these letters that are going out to credit bureaus, she's sending those out and just making sure everything goes smooth in the credit program. Okay. Anybody have any questions?
Yeah.
No questions? We got a cool team or what? I always tell people, listen, when you hire New Home, okay, let me tell you this. When you hire NewHomePrograms.com, you don't get one person, you don't get a realtor, right? You hire an entire team for free. Because why? We get paid by whoever you buy your home with, okay? So you're gonna have an army of people, we're all working on your file in a database, we keep records of everything, right? So at the end of the day, we understand that this is probably the most important purchasing decision that you're gonna make, and we wanna make sure you have a good experience, all right? So Mr. Brent, he has the form in case you guys want to fill it out here. If not, we're going to go ahead and shoot it via email to you guys. And if you're on Zoom, they're probably going to post it on Zoom as well. Now, there's only one thing that I'm going to ask of you guys, right? I didn't charge you for the food. I didn't charge you for the seminar, right? If you feel that this was a 5-star presentation, all I ask is you give us a 5-star review. It could be today, it could be tomorrow, but we're gonna send you out a text message and it's gonna be to our Google page, right? So if you feel that's 5-star, if it's not 5-star, don't give me a review, right? If it's only 5-star, right? But I'm gonna say I don't know you if you give me anything other than 5. But if you feel it's a 5-star presentation today, just get on our Google and give us that rating, right? Because all these people out there that are driving by that have no idea what we do here, right? A lot of times they do find us on Google because our page ranks high because we do have a lot of review and a lot of content on our website, okay? And always feel free to recommend friends and family now that you got to know us and kind of, got to see if we're good people here now, okay?